Today, we're diving into one of the most popular and beginner-friendly option strategies, the covered call. If you're an investor who already owns stocks and is looking for smart ways to generate additional income from your portfolio, this strategy is an excellent place to begin your journey. So what exactly is a covered call? At its core, it's a strategy where you sell a call option on a stock that you already own. This means you're essentially making a commitment to a buyer. You're telling them, I'm willing to sell my shares at a specific, predetermined price, known as the strike price, by a certain future date. This agreement is the essence of the covered call. In return for making this commitment, the buyer pays you a premium up front. This premium is immediately deposited into your account, and it represents your direct income from initiating this strategy. A covered call strategy truly shines and works best under specific market conditions. Firstly, it's ideal if you anticipate that the stock's price will either remain relatively stable or experience only a modest increase over the option's duration. Secondly, this strategy is suitable if you are comfortable with the possibility of selling your shares at the agreed-upon strike price. You should be prepared for your shares to be called away. And finally, it's perfect for investors who are looking to generate consistent, recurring income from their existing stock holdings, adding another layer of profitability to their portfolio. You profit from two main components with a covered call. The first is the premium you collected up front, which is yours to keep regardless of what happens with the stock price. The second source of profit comes from any appreciation in the stock's value, but only up to the strike price. If the stock rises above the strike price, your profit from the stock's growth is capped. While covered calls offer income, it's important to understand the risks. Your primary risk is opportunity cost. This occurs if the stock price unexpectedly surges significantly above your strike price. In such a scenario, you're obligated to sell your shares at the lower strike price, missing out on the additional gains from the stock's substantial rise. You're essentially leaving money on the table. Conversely, if the stock price falls, you still incur losses just like any other shareholder. However, the premium you collected up front helps to partially offset these losses, providing a small buffer. Let's walk through a real-world example to solidify your understanding. Imagine you own 100 shares of Apple, which you purchased at $180 per share. This is your underlying asset. You decide to sell a one-month call option with a strike price of $190. For this agreement, you collect a premium of $200. This $200 is yours immediately. Now, let's consider two scenarios. If Apple's stock price remains below $190 by the expiration date, your shares are not called away. You keep your 100 shares of Apple, plus the $200 premium you collected. In the second scenario, if Apple's stock price rises above $190 by expiration, your shares will be sold at the strike price of $190. Even in this case, you still keep the $200 premium, adding to your overall profit. That's the fundamental power of covered calls. They offer a strategic way to generate steady income from your existing stock holdings, all while managing and controlling your risk exposure. If you found this explanation helpful and want to learn more about simple option strategies, remember to like this video and follow for more insightful content.